The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
You've got the broader context of unstable leveraged finance, which has been proliferating certainly since the global financial crisis. But you could even argue going back to the 70s and 80s. We're building and building and building this edifice of debt. And if we can't make payments and the bill is coming due, what happens? Well, actually, a great case in point is what's happening in the oil market today. There's a number of players who will not exist days from now, weeks from now, months from now.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Today, Dave, the times that we're in, this is a good time to test just how independent a thinker we really are. You know, everyone's being tested with this coronavirus, with the market changes, with what's gone on in oil. What do we do next? And I'm watching a lot of people, watching a lot of other people trying to take their cues from the crowd. This is the last thing you want to do when you're in a crisis situation, right?
We mentioned a few weeks ago that there was an interesting and intriguing psychological and sociological dynamic here where, you know, people are concerned and all of a sudden their behavior begins to shift. And actually you can push and shape and mold human behavior, particularly when people are under pressure.
Right.
And so to be an independent thinker is to do your own homework when it comes to coronavirus. It is to look at the markets and what is driving those market dynamics. And it is to come to some conclusions yourself. Because if you are leaning on the CNBCs of the world or the CDCs of the world,
or even the Trump tweets, right? If you're leaning on that, what are we to do? That's what people are asking. And they're asking friends and family, what have you.
And appreciate that everyone has an agenda.
Yeah.
So
exactly
whether
right.
it's a political agenda or a stabilization agenda or, and that can be a market stabilization agenda or what have you, you do need to make decisions that are realistic and practical for yourself.
Listeners to this program, I believe, for the most part, are independent thinkers. I mean, look at the volatility that we've had over the last week. There's a lot of decisions that could be made in the rush that could be wrong in the end.
As we've encouraged people to raise cash and own gold in the months leading up to this period of time, I'd say luck favors the prepared.
Yeah.
And I don't think it's any different when it comes to, you know, washing your hands and being cognizant of the very practical things that might improve your immune system or whatnot as we consider what this could be in terms of the coronavirus. As we've talked about it in past weeks, this is no big deal if it passes quickly. And it's a very big deal if it doesn't pass quickly. And it's not so much because of loss of life as it is because of the changes in patterns and behaviors which have a huge economic impact. And of course, our job is not to be doctors and diagnose. Ours is to say there are market impacts and there are asset value impacts to those changed behaviors. So again, short duration, long duration, we'll tell you how severe it was once it's in the rearview mirror.
And there's always the black swan that gets the blame, but we've been talking about for months and months and months things that are creeping into the economy. The one thing we didn't have until about 3 or 4 weeks ago was volatility. Boy, has that changed.
Well, yeah, time flies. And whether you're having fun or not, time flies. The stock market peaked February 19th. And in a matter of 3 weeks, we've had sufficient volatility to, as they say, scare the whiskers off a cat. And, you know, how do you normalize a 1,000-point swing in the Dow? A 3% up day or a 3% down day, moves like that in the S&P and the NASDAQ. I think one of the ways you normalize it is you witness a 7% day. And then 3 ain't so bad.
Right.
So, you know, prices seem to always bounce. That's kind of the meme that is repeated over and over again. Don't sell. Hold on for the long run. So you've got the CNBC and Wall Street shills who kind of keep the greater fools, many of whom arrived late. They keep them in their seats and they keep them hopeful. And I think, you know, this is again, it's a time to be an independent thinker.
And the central banks, of course, don't want you to think independently. They do want to move the crowd. That's how come their words are always perception oriented.
Well, you're right. Macro level management to some degree depends on being able to sort of direct the flow of human behavior. And so whether that's macroeconomic management or social management, this is the reality. What has been normalized here in recent years is the market's short tantrums, the central bank's activist, whether it's words or deeds that come into comfort, comfort the speculator, soothe the nerves of the over-leveraged investor. And, that's precisely what we had last week. Last week, when the 50 basis point rate cut was announced, we had another 3% down day, but a little bit of a surprise there. But, it was followed on throughout the week by weakness in commodities, the repo market continuing to be under stress and strain. And we saw this week the repo market, they moved the overnight lending from 100 billion to 150 billion, the 14-day repo arrangement from 20 billion to 45 billion. And then, of course, we've had growing strain in the credit markets as well. So as you've seen spreads increase relative to treasuries, there is a reappraisal of risk in the credit markets, and it's appropriate, I think. And the cost to insure against default has been rising acutely in some areas and noticeably in almost all areas. And you could argue that this time was different, but this is, again, sort of looking at how we treat viruses. Antibiotics don't work on viruses. And effectively, cutting rates doesn't treat the general public's volitional avoidance of the public square. And I think that's where, the 50 basis point rate cut was a little bit different. That wasn't the follow through or impact in the marketplace because, again, it's like antibiotics and a virus. It's the wrong medicine for the wrong disease. So yes, central banks are clever enough to know that, but quantitative easing being the final option is not the one that you want to use until you have to. So cut rates first and then QE next.
One of the things that the algorithms and the professional money managers have sort of just gotten to rely on, almost like sailors on a boat who don't need wind anymore because they know they have the fan always provided by the central banking community. There's always wind in the sails. Central banks have said, look, we've got your backs. From the time that Mario Draghi back in 2011 said we'll do whatever it takes, to the central bank's actions even this week. So how prepared were the professional money managers going into the last few weeks, Dave?
Well, that's a good question, but you mentioned the central banks, and to see the aggregate infusion of capital into the market where essentially we did have QE begin, we had balance sheet expansion by the ECB, the European Central Bank, the Bank of Japan, the Bank of Australia, and the Bank of China and the Fed combined for $675 billion in 15 days.
Wow.
So,
better than $500 billion in that many days.
Yeah. So, I mean, yes, we've got the repo markets, which are part of that, and we've got expanded balance sheet stuff all over the world. And there were a few central banks that joined in with lowering rates as well. Professional money managers coming into the last few weeks, great study by Bank of America, a survey which showed that call option buying was at crazy levels. This goes back to February 18th.
That's going long on the market for those who don't know what a call is. That's going long for the upside.
That's right. If you want to buy stocks because you think prices are going to go up, then the way to really juice returns would be not to buy stock, but to buy options, which give you almost a leveraged play on the upside, specifically if they're in call options. Put options are on the downside.
A put is on the short side. Yeah, you're shorting the market basically. So what is short interest? Let's look back a few weeks. How were these guys prepared for a downturn?
On the survey, the short interest was at its lowest level since 2007.
Wow.
The put-call ratio was at a 10-year low. You had cash levels, again, this is a day before the market peak, cash levels at a 7-year low. And money managers were, even on February 18th, boosting their stock holdings up to the point where the market puts in its peak February 19th.
Hindsight is 20/20, but that's how it always works, Dave.
If you're tempted to think the efficient markets are all-knowing and that algorithms today are there to sort of fill every arbitrage gap, think again. You're talking about a very historic exhibition. What's on display is sort of the uninformed collective judgment, right? This is not the wisdom of the markets. This is the uninformed collective ignorance, if you will, judging that this is a great time to be putting money to work.
Follow the crowd.
And so call it hopium, call it betting with the Fed and not against it. But I have to say, in the last few days, and again, this is not some sort of schadenfreude. I take no pleasure from the market's decline. But if anything stands out to me as encouraging in this episode of financial market chaos, it's that the markets are in control. It's that the Fed is not. And even when you've got Bullard proclaiming nothing's off the table,
right,
which he was on Bloomberg saying, using his version of we'll do whatever it takes, the free market is alive. The top-down social engineers are a bit confused, a little bit struggling to make sense of it, because from our vantage point, math is once again a verity. It makes sense. You can rely on it. You are not crazy for thinking that too much debt will get you into trouble. And so I think what we have over the next 3 years is that there is actually hope that zombies will finally be put in the grave.
Let's explain that. Okay, because really free markets are zombie killers. And that's a wonderful thing actually for the healthy person, because a zombie is something that should be dead that's alive, right? And the free markets kill the zombies, but the central banks will keep them alive, and it actually turns into a cancer on the system.
Yeah, free markets are self-regenerative in the sense that a bad idea comes along and it fails.
Right.
And there is a harsh reality to the free markets. Whereas, when you infuse capital, cheap credit, unlimited access to it, you can take a bad idea and you can extend the life of that bad idea well beyond its normal cycle. And so you're right, the free markets are like zombie killers. So when you think of the money manager community, I would suggest that to a large degree, you're talking about the blind leading the blind. That's right. Not to say that they don't read the Wall Street Journal or have the jargon down, can't speak to, earnings and get sort of wrapped up in that world. That's great. But I think over the next 1 to 3 to 5 years, you as a listener are going to remember, I hope you remember, the B of A survey. And I hope it leaves the same impression that, Citigroup's CEO, remember Chuck Prince?
Yeah.
He said back in 2007, as long as the music's playing, you've got to get up and dance.
Right. And most of the time, that's true. When you're talking momentum and you are a professional that could lose your job if you're not doing what everybody else does, guess what you do? You do what everybody else does until you get crushed.
Well, which is why when I was at the real estate conference a few weeks ago, I asked the question, what happens when liquidity stops? Your business plan, how does it operate? How does it operate? There was a debate between you should be buying more real estate right now or you should be selling real estate right now. And the folks who believe that you should be buying whole hog right now, I was asking everyone, how does your business operate in an environment with no access to liquidity? And nobody had an answer.
Right.
Because liquidity is something that you take for granted. And that actually was a part of Chuck Prince's commentary, because he said, when the music stops in terms of liquidity, things will be complicated. And then you remember the rest. But as long as the music's playing, you've got to get up and dance.
Well, and a lot of times these guys don't have skin in the game. I mean, let's face it. The banks were bailed out this last time. Executive salaries did not go down when most people's 401ks did back in 2008. But investment professionals, they're humans, Dave, like anyone else. They see what they want to see, and they're also seeing what other people are doing. Again, using that example with the coronavirus, I got to admit, I'm looking around to see what other people's reaction is. And then I have to say, all right, well, is that going to be mine?
And the investment community, quite frankly, is very unforgiving when it comes to underperformance. If you are less than the benchmark, you're fired. As a consequence, we see investment professionals clinging to job security, and that means playing momentum up into the point where momentum shifts and they're wrong. So you're right until you're wrong, and that's okay if you're wrong as long as everyone's wrong around you, because then you can't be judged, right? So that's a fascinating dynamic in terms of preservation of professional viability. You can't afford to be wrong. And what we've always said is eventually you're going to be wrong. It's more painful from a monetary perspective to overextend the stay and let the market claw back from you 30, 40, 50, 60% in a market decline.
And those who were prepared underperformed before. Okay, that's just part of the price you pay to be prepared.
And so can you live with being wrong and missing some of the upside, right? So in an ideal world, you'd say 80-20, miss the bottom 10, miss the top 10, and stay solidly in the middle. And maybe more realistically, it's more like 15 or 20 on the low side, 15 or 20 on the upside, and you've got to be comfortable with more of like the middle 60, middle 70. But that means that the market will continue to move away from you. And there are periods of time where you're going to be wrong. And this is the importance of independent thinking, because if you haven't come to conclusions on your own and understand the assumptions upon which you based your decisions, all of a sudden it is a free-for-all for who's got the best idea. And is it Jim Cramer? Is it somebody else on CNBC? Was it a quote from a guy at Goldman? Do I get the McKinsey report and they tell me what I should do next? I mean, there's so many things that an investor in a panic doesn't know how to process. And what I'm saying is if you just engage the process, you're going to find that actually you are more effective than even the investment professional, which is what you were mentioning earlier. We've got the investment professionals, which are all too human. That, like anyone else, they see what they want to see. And generally speaking, they believe what makes them feel good. No one wants to dream of apocalypse, whether that's with zombies or without zombies. But, I think there's enough cycle studies. Those are plentiful enough to be sober-minded in particular seasons.
Okay,
right?
But you're talking about humans. What about all the algorithms that have been trading? Because what is it? About 70% to 80% of the trading is HFT and algorithmic trading?
Right. So high-frequency trading and algo trading, the trend in recent years has been away from professionals, as in human beings, and towards machines, less emotional, and the argument is, frankly, more reliable. So, you enter the robo-advisor. The robo-advising alternatives have proliferated, they're being very popular.
Or how about the free brokerage services, where you pay no commission whatsoever, like Robinhood? Well, look what happened to Robinhood on Monday.
Sometimes you get what you pay for. The robo-advising alternatives like Robinhood. Again, this is where algorithms are opening the way for low-cost investing, smarter, quote-unquote, investing, and perhaps even sort of a low-volatility journey to Elysian dreams. If you're thinking of retirement and just a world of beauty and relaxation, and Robinhood had a few problems.
Robinhood turns to Terminator. Yeah,
exactly.
It's a little bit different. Yeah.
So you've got the robo and auto, which have a lot in common with sort of the pilot that augers into the ground. And it seems that 3 times in the last few weeks, with Robinhood in particular, you've got the algorithms which were overwhelmed.
Yeah.
And they shut down. Yeah. And I just can't help but make this connection. When an algorithm is overwhelmed and shuts down, does that not actually reflect the humanity of the programmer?
Right.
I can't handle stress well. You know what I'm saying?
Isn't it amazing that they shut down, however, only when people want to sell? It seems like the algorithms really work well when you want to buy.
So the platform collapses in disarray when people want to sell instead of buy. You're right. So, but since the global financial crisis, there's been this massive increase in the number of financial products that promote traffic flow in. And that traffic flow in is like a 6-lane freeway.
Oh, yeah. Here you come.
But you try to get out, and it's a little bit more like a goat trail in a ravine.
Hotel California.
If you're trying to get out, it's there's a little bit of a bottleneck. So we've often referenced the overvaluation metrics. And those are not necessarily a great timing tool for trading the market, but they are, I think, a very timely reminder of what will influence your average returns over the next decade. And so when we say average, we mean average. I mean, some years are going to be great, some quite ugly, but on average, over the next decade, what are you going to get? What we get to factor into the next decade, and this is one of the reasons why we've been talking about overvaluation, you get to factor in 20% moves lower, like we've seen in the last 2-3 weeks. And if you think about it, this is very common in the context of a recession to see a 30, 40, 50% decline in equities. And in a severe recession or depression to see 50, 60, maybe even more than that, percentage declines.
Right.
So, just saying, okay, well, if we saw that typical recessionary trend that impacts the stock market because earnings decline, et cetera, and you have a repricing of assets, okay, well, you could see a move lower in the Dow to 14,000, 15,000. And again, we're talking about average returns. Where does that put you over the next decade if you spent the first part of the decade stacking in negative numbers, pretty big negative numbers?
For the person who has made their call to their financial advisor and said, all right, what do I do? And he says, look, just hold on for the long run. I can tell you, in 1987, the stock market crashed. People lost 30 to 40%. Then they worked their way back up, maybe broke even by 2000. Same thing. They lost 30 to 40%, depending on where they were. Then they worked their way back up, maybe a little past break even, and then 2008, boom, lost 30 to 40%. Now we have the same type of thing going on. And so there's an illusion that if you just hold your stocks long enough, you're going to do fine. So in the long run, yes, holding stocks does help, but it's not just as simple as holding everything just the same. This professional management, let's look at the long history of equity markets and actually see the truth in that.
Yeah, the only thing I would back up on that is to say the 74 recession was a pretty nasty one. 87 was more of an anomaly, and it wasn't your typical 30, 40% decline. It was 20% in a day, and we recovered pretty quickly thereafter. But that didn't have the structural dynamics that you had in the 70s, or certainly what you had at the end of the bull run.
Well, in the 70s, that wasn't a crash, was it? In the 70s, that was actually just a slow degradation of the markets.
If you lost 30 to 40% in the market, you lost an extra 20 to 30% on top of that because of negative compounding as a consequence of inflation. So your real rate of return was even more deeply negative because inflation was helping you sort of auger in. And so, yeah, I mean, how do we get to lower levels? I think this is something that takes months to years. The road ahead is not an easy one. And yeah, if you're talking to your financial advisor, again, I first and foremost, I'd say do your thinking for yourself. There's attitudinal dispositions. You can see this with coronavirus. There's people who are going to panic. There's people who are super paranoid. There's people who are super careless.
And some will take a cruise.
Yeah, because it's cheaper right now.
Because it's cheaper right now.
Yeah. So in what you have is an expression of personalities. Typically, the personalities that are attracted most to the financial advisory business, which is different than asset management, but the financial advisory business, these are very positive thinking, very well spoken, somebody who can glad hand and kind of work the cocktail party, great to talk with on the golf course, super personal, just very emotionally engaged. And so, keep in mind, you're dealing with someone who wants to see the best in every circumstance, typically in the financial advisory business. You probably need to think for yourself, and there's times that you can see the best because realistically that's what you have to look at. And other times where a realistic appraisal is something quite different. So what I would suggest is that you sell the rallies. I mean, we will see some rallies in here, but I think what we've determined by looking at the credit markets is that something very, very odd has just occurred. Go back to 2008 and 2009, when you had significant selling pressure all through late 2008 and through March of 2009. Where did the 10-year Treasury get to? You're talking about panic buying. People wanted the security of the Treasury market where they knew they had a liquid asset. They were not going to be concerned about inflation, even though you had a major ramp up in commodity prices and more of a visceral concern or an obvious concern about what could have been inflation. You look at commodity prices back then, we're talking $100 to $130 a barrel just coming into the financial crisis. Where we saw the 10-year Treasury it got to a low of 2%. Monday, we saw the 10-year Treasury get to 31 basis points. And so to have basically scraped the bottom of the barrel in terms of interest rates without going nominal negative is fascinating, absolutely fascinating. The 30-year Treasury slipped to less than 1% this week. And so again, you say to yourself, well, what is different this time? What's different is palpable fear within the credit markets, within the bond markets. You have fixed income investors there's almost two groups within the fixed income world. Those who are still buying with reckless abandon the investment grade products, not realizing that the vast majority of the product in the investment grade category is sitting at BBB, just waiting for a downgrade. Again, it will have to be chucked out of those portfolios, moved to junk portfolios. Forced liquidations equals fire sale pricing, right? So you've got something quote unquote investment grade, which is getting ready to catch fire, right? And so there's people who don't know that, don't appreciate that, are just looking at higher yield and see the quote unquote investment grade and think that's higher quality. And so they're willing to take the risk. The other category of fixed income investor is someone who's Treasury only. And they say, I just don't like the looks of this environment. And I think I need liquidity and I think I need asset preservation. And so to some degree, you see a few of those dollars move in the gold direction, but a large percentage of those dollars go towards treasuries. So 31 basis points.
Right. Near negative. Jim Deeds, right before I walked into the studio today, and Jim's been a guest of ours for those who haven't heard him. He's going to turn 88 here soon, yet he stays so actively engaged. He's been in the stock market since the 1960s. He was a broker for many years. He actually worked here for years. And he called me up and he said, Kevin, I just got to tell you, he said, the bounce that's occurring today, because the stock market was up. He says, the bounce that's occurring today, he said, this is what we call in the market a dead cat bounce. He says you're going to see a bunch of these all the way down to 3,000 points. That's what he said.
Well, so he's picking a rather low number, but I think 14, 15,000 on the Dow is more realistic than 3. I think the long history of equity markets is a series of moves to higher highs. So over the long term, yeah, Jeremy Siegel's right. But the painful punctuation lies in the one step back, which statistically puts the market in regress mode 40% of the time. It's a 60-40 split. 60%.
We've really forgotten that, haven't we? We thought it was 100% of the time that you make money, but 40% of the time is regress.
On balance, it pays to be bullish on stocks for the long run, but it also pays to be engaged in risk management. Think for yourself, so that while you keep a long-term bullish attitude, you can stay positive. But over the long term, you don't want to be forced to endure these massive tests of patience in the interim.
Okay, so we've had 10 to 12 years of growth. If you figure the 2008 crisis, let's call it a decade, maybe 9 years of growth. What that means, if you're saying a third of the time or what have you, a quarter of the time, we're talking, 2, 3, 4 years now where we could have what you're calling regression.
This is textbook. This is Dow theory. So bear markets typically last 1/3 the length of a bull market which preceded it. According to Dow theory, this goes back to Charles Dow and Hamilton and Rea, and the most recent iteration would be Richard Russell. But bear markets typically last 1/3 the length of the bull which preceded it. So we've had a 12-year bull market in equities, depending on where you want to count it from.
We spoke of the religion, basically, the new religion of perpetual growth. The central banks have pretty much written the book on perpetual growth. What you're talking about here doesn't match that outline.
No, I mean, so the central bank community is crafted this global construct of complacency. This is how we got here. They create complacency. No one needs to exhibit adult-like behavior. No one has to be responsible if you've already chosen the designated driver. That's who we have. Central banks have said, we got this covered. So leverage builds, risk-taking becomes commonplace within the financial community until you've got the whole financial landscape, which is rife with speculative bet upon speculative bet, growth based on unsound finance, not unsound business practice. That's the big contrast, is that it's unsound financial engineering as opposed to a really well executed business plan. And so complacency grows as things, you do see a step back. All of a sudden those risks are socialized, and you end up with greater and greater zombie-like characteristics.
So let's look at these zombies, because the zombie companies, actually, a lot of them used to actually produce something. Look at General Electric. Unfortunately, we're talking about Welch after he's passed away, but he really did change the entire culture of how GE works.
Right. Well, we discussed GE last week. And again, it's not because I'm a fan of GE, but it serves as a great example, particularly since it's the only Dow component left after 120 years. But I want you to know, when we talked about the GE to gold ratio, we were talking about taking those 100 ounces of gold and putting them into GE and being able to buy 16,000 shares. Well, with this week's market volatility, you just bumped from 16,000 shares to 20,300.
Wow. What a great example then last week.
But again, Jack Welch he's the poster boy, not of management genius, but of unsound corporate finance, of reporting chicanery. I mean, under his guidance, GE perfected accounting gimmickry, and they set the model for corporate management pillage of the shareholder. That's really what I remember him for. And he perfected what corporations can now use GE as a model for, which is offshore tax arbitrage. There's so many years in which GE never paid taxes because they had 1,000 accountants managing how to create offsets and create transfers and various things between entities overseas.
Even if that's not good, was it just an adaptation to what the central bankers were providing? I mean, you were talking about the zombification of companies. A lot of times that's a survival mechanism for companies that would have gone out of business.
I'm not talking about him doing anything illegal. This is basically shifts within the capital markets, which began in the 70s and then accelerated in the late 90s with the end of Glass-Steagall and kind of a reduction in, sort of management expectations. I think it was the early 80s, which they started allowing stock buybacks, 84, if I'm not mistaken. And it was fascinating because prior to that, stock buybacks were considered to be a form of manipulation of the stock. But then 84 to the present, you start remunerating CEOs with huge packages of stock options and things like that. So none of us are all good. And none of us are all bad. And Jack Welch certainly fits right there in the middle with us. He certainly had a lot to offer of a positive nature. There was many of his leadership attributes which are to be admired. But my point here is that GE stands out as an example of an entire corporate landscape that has become dangerously leveraged and dependent on financial engineering.
Right.
One of the contributing factors is, of course, access to cheap money and the enabling of this, the zombification of corporate America is, in fact, monetary policy. That's really the key generator of these corporate zombies.
The older investor is going to say, okay, but things change. They change. And when they change, you lose a lot of the people who were standing in the same room with you.
Buffett used to say that you get to see who's swimming naked when the tide goes out. And I think that's the same with credit. When credit tightens, you get to see who is the walking dead among you.
I was just talking to somebody this morning and they were saying, wow, what a difference 2 or 3 weeks makes. There was such optimism. So 2 weeks ago, we were talking about the supply chain disruption with COVID-19. Now we've had other factors. The Bible talks about birth pangs coming closer and closer together. In a weird way, we've had that. We talked about COVID-19, then supply chain disruptions. Then all of a sudden we had the stock market really reacting. And then we had the OPEC crash. It really does feel like it's coming more and more rapid, doesn't it?
Well, I mean, it's not unlike 2008 when we were starting the podcast. It's 13 years ago where, it was rapid fire from the get-go. Every week was like, drinking from a fire hose. But yeah, we have a short mental break here from those supply chain disruptions. We've got the changed consumer behavior because of COVID-19. And I would say this week, very key, watch the sentiment numbers that are out this Friday. It'll be fascinating to see what 3 weeks in the volatility meat grinder has done for the average investor, the average consumer. How do they feel? So we transition from that to the fireworks that were lit in Austria this last Friday. The OPEC meeting, the OPEC Plus meeting where Russia was involved, not a member of OPEC, but...
Well, let's look at that because that's not exactly what we see on the surface news. When we interview, you just interviewed George Friedman not too long ago. One of the things I love about George is he gives you a perspective as if the world is a chessboard. And it seems this OPEC meeting isn't necessarily what it seems. There's something underlying that.
Yeah, I mean, there's a lot in play here because you've got two countries which require higher oil prices to pay their bills. In other words, they've made so many... we talk about guns and butter policies. These are countries that do have both. And particularly the butter policies where they're taking care of their constituents. They've got social programs which they're obligated to. Both Russia and Saudi Arabia generate a lot of their revenue from oil. Okay. So that they're major contributors in the oil market.
Well, replay that sequence then. What actually occurred?
Yeah, well, in a nutshell, Saudi Arabia suggested at the OPEC meeting on Friday, it ended on Friday, that there would be cuts in oil production to support the price in light of COVID-19 and this coronavirus and it's the impact that it's having on global oil demand. So what they're just suggesting proactive price management by turning down the tap, not turning off, but just turning it down. And, since 2016, Russia's played a key cooperative role in aiding the Saudis and the rest of OPEC with managing sort of the global supply of oil ex the United States. And 2014 to 2016 period was brutal in the oil markets. And Russian cooperation from 2016 forward has helped set the tone for the oil markets, stabilizing them since then. So prices stabilized, prices moved higher, and U.S. shale was given a whole new lease on life, pun intended. But fresh drill techniques, they were working off of those. They had prolific acreage. And here in the U.S., the shale patches, they were developing only the best wells. Even in a low price environment, they had kind of been forced to refine and just focus where they could see best return on capital with each dollar spent. And so the refining process was there, which was helpful towards bringing their cost structure down. And then you had the supply side being managed by the Russians and the Saudi and the OPEC group. And so, gradually what we saw over the course of time was the U.S. moved from 8.5 million barrels a day of production to over 12 million barrels a day.
So in a way, the higher prices that were helping Saudi Arabia and Russia in the short run were actually creating and building their greatest competition, which is U.S. shale.
Yeah, they helped build their U.S. shale competition. So the cost of cooperation with OPEC has for several years, it's set the stage for giving U.S. shale a larger and larger share of the global oil market. So that issue of market share is a huge factor here. Last week's Vienna meetings proposed basically more of the same. In order to stabilize crude oil prices, the proposal was going to be to reduce supplies to meet the lower levels of demand as a consequence of coronavirus.
And that's where Russia walked out. Russia just said no way.
Right. The surprise was, they've been playing ball. Russia refused on the basis that stabilization costs, if they were going to stabilize the price of oil, it was coming out of their hide and leaving the door wide open for the U.S. shale producers to march right on towards 13 million barrels a day and beyond, taking even more market share from OPEC. And in essence, what they're doing is they're gutting the earlier international geopolitical order and oil pecking order. So this is where they want to make sure that they can take back some market share and make sure that the international geopolitical landscape, where power is wielded by the largest global oil producers, that they aren't completely written out of the script.
And this is what's delicate, though. What's delicate is Saudi Arabia needs U.S. protection. They need U.S. favor. And so how in the world do you crush U.S. shale without having some sort of distraction between them and Russia, right? Is that what you're saying?
Yeah, and you've got to play this with a strong poker face because on the one hand, you're willing to crush the price. Both the Russians and the Saudis are willing to crush the price by non-cooperation and then setting the prices at a lower level in tandem. But Lila, who does a lot of research for us on individual companies within the energy space, would say you got $45 a barrel, which is required, bare minimum, for Russians to pay their bills, to keep the lights on. And the Saudis have made so many social promises and are paying out so many things in terms of benefits to the Saudi citizenry. They need $80 just to break even. Now, of course, that's not to say their oil production costs are that high. They're more like $3, $4, $5 a barrel, under $5 a barrel coming out of Guar and those large fields. It's like giant pools of oil.
But they've just committed those funds. Yeah, they've committed those funds to the degree that they need $80 a barrel oil
to stay fiscally break even as a country. Right. So the Saudis reacted to the Russians, and as they declared war on each other, conveniently, the U.S. shale industry is positioned right in the middle, taking fire from both sides. And I think diplomatically, it's brilliant. Because the cast is it's the Saudis against the Russians. The Russians weren't playing ball. The Saudis are playing hardball with the Russians. But both of them are hoping to chop the U.S. oil production capacity down to size.
Yeah, so Shakespeare said all the world's a stage. This was a stage.
Absolutely. And you can recall that, the U.S. is still using sanctions against Russian energy companies. Rosneft comes to mind. They're trying to pressure Russia on the Nord Stream 2 pipeline. That's a pipeline that's to deliver Russian gas directly to Europe. And again, when you start thinking about energy as a tool, not just for something that sort of keeps the lights on or fuels this or that, it's a geopolitical tool, and it can either be used as a carrot or a stick. And so what you have with the Nord Stream 2 pipeline is basically the stripping out of U.S. influence into Germany and France by getting reliable sources of gas directly to. And if you can create a dependent relationship, then all of a sudden you start defining the nature of international relations going forward. And that's what Nord Stream 2 is all about. Obviously, it's revenue and it's selling product and all of that. But there's more to the story. There is a geopolitical component. And here Russia has found a way to retaliate. They found a way to retaliate by basically going after U.S. oil. And hopefully, in their view, hopefully shift the pressure. You talked about the chessboard earlier. They're shifting the pressure on the energy chessboard.
Sure.
And so now you have scores of U.S. energy companies which are pricing in bankruptcy this week.
Sure.
This week.
Yeah, and so we will see a contraction in the shale industry. But what you're also saying, I think the Germans were dependent, you've said this in the past, about 50% of their oil dependency is on Russian oil. And what the Russians are doing, they're stepping that up. It's going to cost them. They have to take lower oil prices for a while, but you crush the shale oil industry in the United States and you pay the price for it initially, but ultimately gain power.
Yeah. So the severity of this particular issue for the U.S. shale players and the ultimate consequences, which could be both liquidity and solvency related, ties just like the coronavirus does to duration. I mean, if this is something where, again, we're playing a little bit of poker while we talk about chess.
How long can you stay at the table?
How long can you stay? Because like for the Russians, if 45 is your number, we're well below that. If 80 is your number in terms of revenue per barrel that you need to pay your bills, how much margin do you have? How much do you have in reserves such that you can play this game? Because to really damage U.S. oil, you got to extend that. You got to extend it 3 months, 6 months, 12 months. I mean, the longer duration, the greater, the deeper the pain, the more companies, they're gone, right? So, the Saudis dropped the oil price, and these are amongst the largest declines in history. This is a surprise move, caught the oil complex off balance. And so it raises some questions. Today, who's driving the OPEC bus? You've got Russia when we say OPEC plus, we're talking about, not like plus sizes for Saudis. We're talking about Russia. They're the extra in the mix. So is Saudi now kind of calling the shots for OPEC vicariously by their non-participation? Who just turned the oil patch inside out? Saudi had a play in it, of course. Russia had a play in it, of course. And again, I think it was masterfully played, diplomatically played, where they get to be shooting at each other, and it just happens to be the U.S. shale right in the middle. Okay, so what we just saw this weekend really set the tone for that first 2,000-point decline that we saw on Absolutely, Monday. Because last Friday set the tone for the credit markets, and it set the tone for the energy markets. Obviously, oil was off. Kind of underappreciated was the crude decline of roughly 10% on Friday, right? And that led into sort of oversubscription of repo markets early this week, declining treasury rates this week, a healthy gold price. I mean, both of these are sort of extended trends from last week into this week, but the oil market debacle, as Lila like to call it, dumpster fire, really got things started in churning for the market open on Monday. For the overnight futures as well. But I think what develops over the next few months is likely to reshape shale. And thus, you're talking about a different U.S. production profile going forward. So how is this different? Because we had a blip in the markets back in 2014, 2015. Is this different this time? Yeah, I think it's going to be a far worse crisis for shale through that period, even coming through 2015 and 2016. Cheap credit at that point enabled a whole lot of drilling. That was then. I think credit dynamics are going to change, even though credit is cheap according to, the 10-year treasury, the 2-year treasury, the 30-year treasury. Availability may be a different issue. Bank lending likely to be constrained there into the oil patch. And I think shale producers at that point in that period of time were able to cut costs. And again, it's like if you think about it compared to a hard rock miner, if you've got a rich vein to the right and a really skinny vein to the left and you're under financial pressure, you go to the rich vein because it's going to be more cost effective to do that. That's exactly what the oil producers did. They went to their land, which was the best, the most prolific acreage. They were selective in their drilling, and they were very effective by doing that. Also got the support from Wall Street. Private equity started coming in and doing acreage plays there as well. And that provided a huge financial backstop for shale in that 14 to 16 period. But no encore performance this time? No, I don't think we have an encore performance. So we already have out of the Beltway this talk of a national oil company. Consolidate the zombies of Marcellus and Eagle Ford and Permian and Barnett and Bakken and all the rest. And I mean, it's an interesting idea. It kind of reminds me of an SPV, special purpose vehicle like we had in 2008 and 2009, where pressure starts to build, credit starts to deteriorate, and things get ready to blow up. Create a bad bank. In this case, it's like a bad oil company, not bad as in moral bad, but where you take all of the zombies to sort of congregate. And if that occurs, I mean, what do you end up with? You do stabilize the oil market from free fall, and you probably stabilize the credit markets, at least as you look at the high yield market's exposure to oil. But what you're doing is you're institutionalizing, you're preserving the zombies for another day. I'm going to shift to gold here because a lot of the listeners, hopefully all the listeners to this program have some gold. And one of the arguments that people have against gold is they say, well, it doesn't offer any interest or it doesn't produce a dividend. And that's true. That's true. So there is an opportunity cost really with any investment, but gold especially if let's say that you can really make a lot of money in the stock market safely,
or you can really make a lot of money in the credit markets safely, then gold is less necessary. But let's talk opportunity cost.
When you look at wealth from a long-term perspective, if you think of this in terms of sort of a multi-generational project, there are ways in which you generate riches. And that may be employment. That may be speculation. It may be starting a business and selling a business. But there is a difference between riches and real wealth. And real wealth is, whether it's stuff like farmland, fine art, gold ounces, it is stuff that has a permanence to it, which is different than a business which may have a very short life cycle, or a product which, again, is popular today, not popular tomorrow. You can create riches with those kinds of things. But your job, if you're creating something that is going to last through the generations, is to figure out what this balance is between riches creation and wealth preservation. We're kind of at the periphery of what we talked about last week with the Dow Gold ratio, with GE, where again, if you're building ounces over time, you're expanding a financial footprint. The dollar value doesn't matter to me. What I do care about is acres, ounces, and if you're able to ultimately expand that financial footprint. We did this last week. It didn't look like gold did much, but in fact, looking at the Dow Gold ratio, we moved from 15 and change back towards 14.3. On a percentage basis, you expanded your financial footprint. The gold market did what it was supposed to do in this value exchange equation. The opportunity cost, this is the big bugaboo when it comes to gold. Why would you own it when you can get paid to own anything else, whether it's a dividend yield or income in a savings account or what have you? So gold and opportunity cost. What we've seen over the last 2 decades actually is that the opportunity cost of holding gold has declined. And think about this. Rates have moved lower and lower. So that's one factor, is interest rates compared to gold. Your reason to have money in the bank versus money in ounces has just diminished. It's one of the reasons why I like the vaulted program. I think we may be entering a period where we have orchestrated lower or even negative interest rates, in which case you recalibrate the way you think about your savings in the bank. And I wanted vaulted to be a savings alternative in that regard. Opportunity cost gone. You're not getting any income? Well, then what would you rather have? Greenbacks, where there is now a debt relationship. Your money is actually being lent out and speculated with. Or do you want just the real thing? Think about Hetty Green. If she wants cash in the account, what is it? It's gold ounces.
And you know what you're talking about, Dave. You've brought this to my attention and the listeners' attention. There was a thesis that was written back in the 1970s by Larry Summers and Barsky. Remember that? The Summers-Barsky thesis? And it talked about that. As opportunity cost diminishes in gold, in other words, as people get less in the way of interest or less in the way of returns on, capital returns in the stock market, they're going to move toward gold, but there's not a lot there.
Yeah, this was some of our earlier shows, going back 10 years ago or more. Gibsons Paradox and the Summers-Barsky thesis was the paper. I don't remember if it was late 70s, early 80s.
I think Gibson's wasn't it? That's
the Summers-Barsky thesis was, I think, 80s. And so the long-term aficionados of the Summers-Barsky thesis, the final ingredient is shifting investors who might be interested in stocks and bonds, shifting investor traffic towards gold. We're talking about a relatively static supply of gold. It's not like we're quadrupling the supply of gold every year. The stock is relatively limited. It's the stock market selling off. Mm-hmm. This is, again, the basics of the thesis are this. In the absence of competitive returns, gold becomes more attractive. Just leave it at that. In the absence of competitive returns, gold becomes more attractive. So we're either talking about an income play where you've got a savings account or a bond yield, which is more attractive. Why would you own gold? You would not, right? But now in a low to negative interest rate environment, it makes more sense. And if stocks don't represent growth potential, then why? Again, the basics of the thesis are that in the absence of competitive returns, gold becomes more attractive.
Right. A child would understand that.
And what people don't appreciate is the limited supply of above ground gold.
Right.
What we often reference as supply inelasticity, again, you can't double or triple up on the amount. You can't run extra shifts to increase the supply. there is a very finite universe of above ground gold that is available for investors. That makes for dramatic pricing of the asset when the alternative investment choices lose attractiveness. So brush off the Summers-Barsky thesis and recognize that between lower interest rates and pressure within the financial markets where stocks don't offer unlimited and one direction upside. Okay, here we go. And I remember from the Quarterly Journal of Economics, an article titled Durable Exhaustible Resources. It said, the willingness to hold the stock of gold depends on the rate of return available on alternative assets. We assume the alternative assets are physical capital and bonds.
Right, where you can just come up with as much as you need.
So if you haven't read the Summers-Barsky thesis, it's a strong argument for gold's role not only as a portfolio diversifier, which it is, and it gives a thorough explanation of gold's negative correlation to market returns. And you can pencil it out somewhere between 75 and 88% negatively correlated to stocks.
Explain that. Okay. What you're saying is it goes up when stocks go down.
Let's say it's between 75 and 88% of the time.
Right.
They will move in the opposite direction. So there's some room in there where on a given day, let's say stocks go up, gold goes up. Right. Well, wait a minute. I thought you said they were non-correlated. Why aren't they moving? Because it's not a one-to-one.
This is a longer term.
And it's not a one-to-one correlation. It's
right.
between 75 and 88% non-correlated. So the summary, I think this is a sufficient way of looking at it. When stocks and bonds are doing well, gold doesn't have much of an audience. I think that's pretty straightforward.
Right.
But when those traditional assets are not performing, that's when you see the audience for gold increase. You've got the limitations of supply, which makes for very compelling returns.
Like you had said, I mean, the stock market actually just recently was 20 ounces of gold. Okay. It took 20 ounces of gold to buy the stock market. Now it only takes about 14 ounces of gold to buy the stock market. That's a pretty quick change.
That is a pretty quick change.
Yeah.
And I think, what we talked about last week is that we ultimately get to 5-1, maybe even 3-2 or 1-1 on that ratio. And that's a pretty dramatic expansion of your financial footprint because again, price is one thing. The ratio gives a clearer message on long-term expansion of wealth. Again, if you say, all right, well, there's ways in which I have made my riches. I had a great job. I saved a lot. I've speculated on this or that venture. And what do you do to then secure your riches? You translate them into real forms of wealth that do not go to zero. And that's where, again, expanding purchasing power is really critical. Putting it in terms of a ratio where you are, over a course of time, expanding, maybe it's shares, maybe it's acres, maybe it's square feet. I think that tells a truer tale than if you're just looking at a figure, a dollar figure on a page, right, which is priced in some random fiat currency.
Well, and it might answer the confusion. Oftentimes people will call in and they'll say, well, gosh, the stock market's down today. Why isn't gold up? But it's really, in the long run, the wrong way to measure in the first place. But the negative correlation does not kick in on a daily basis anyway.
No, and I think there's enough, it's on balance, they're negatively correlated. On balance is the qualifier there. 88% is a good number to tie onto that. Why did gold not go up as the Dow collapsed on Monday? Again, I think we're talking about nominal terms versus Dow gold terms. It reminds me of something that Richard Russell said over and over again about bear markets. The person who wins is the one who loses the least. So in gold terms, you may actually expand your financial footprint. And so, yeah, I think what we have in the weeks ahead are the surprises from the Federal Reserve. Bullard on Bloomberg TV was just saying everything is on the table. We're willing to do whatever it takes to get through this. He's talking about the coronavirus. He's talking about market accommodation. And yeah, I think everything means everything. And so when you see the floodgates opened, whether it's liquidity, we mentioned $675 billion between, and this is balance sheet expansion from 1, 2, 3, 4, 5 different global central banks in a 15-day period. Everything's on the table, right? And so you begin to see the reaction of the markets to that kind of dialogue. Rates on the 10-year reach a low of 31 basis points.
That's amazing.
30-year below 1%.
Yeah.
Lowest we've seen on the 10-year. Again, I can't believe this. Back in the 08-09 crisis, 2%. Fear and panic entered the market in 2008. And then what followed was a series of interventions in QE. Gold went from $700 an ounce to $1,900 an ounce. Silver went from 6 to 7 to 8 to 49. And I think now the only conceivable choices are QE to infinity.
Right.
But here we are in a broader context, and this is where I think the markets are absolutely fascinating. The oil sell-off, credit market risk is now being reappraised, and this is all happening within the last few days. Because as we said, the market peaked on February 19th, and yet the market was not appraising risk at all on February 18th. Put call ratios 10-year low, cash 7-year low. All of these factors which would suggest that complacency reigned just 3 weeks ago. We lived in a perfect world. And it's only in the last 7 days where we've seen a ramp up of concern. Investment grade, high yield, emerging market, the financial markets, all of those areas where credit default swaps have begun to mark real stress and strain.
We're not in Kansas anymore, Toto.
No.
That's just it. Things have changed.
But literally, just a few weeks ago, we were at levels of complacency which were identical to 2007,
right,
prior to, and this is again the perfect world of 2007, prior to the global financial crisis. And the key turn in the credit default swap market was only in the last week. You can tell this is radical. The leverage speculators are being put to the wall. We've got hedge funds, which at the end of the quarter, you'll see a number of them liquidate and go home, take their marbles and go home. Look at the wildness that's happened. You think 2,000 points on the Dow, 7 percentage points means anything. We had between a 40 and 50% shift in the 10-year treasury in a 24-hour period. That is radical. That is radical. Currency swings, again, currencies swinging violently. Yields swinging violently as you saw an unwinding of carry trades. These are huge dynamics. And what they suggest, what they have in fact confirmed, is that our thesis is correct. What is the thesis? That there are layers of instability within the financial system. And those layers of instability are revealed at a point in time and then have to be dealt with. But the context, it's not coronavirus. Coronavirus is the pin that pricks the bubble. You've got the broader context of unstable leveraged finance, which has been proliferating certainly since the global financial crisis. But you could even argue going back to the 70s and 80s, we're building and building and building this edifice of debt. And if we can't make payments and the bill is coming due, what happens? Well, actually, a great case in point is what's happening in the oil market today. There's a number of players who will not exist days from now, weeks from now, months from now.
I'm reminiscing here a little bit, Dave, because, even though I go back to 1987 here at the company, and you go back further than that because you were born into the family, okay, there was a real turning point for us in March of 2008. We're going into our 13th year now of the weekly commentary. But a lot of those years we've been supported as an economy with artificial money, artificial stimulation, quantitative easing, artificially low interest rates, the whatever it takes mentality. We're starting to see that break down. When we started this program, we were in the middle of a financial crisis. Remember that? 2007, Bear Stearns tried to sell toxic debt. It was only $400 million worth. I mean, it was a small amount, and they couldn't sell it. So they pulled it off the market, hoping nobody saw, but everybody saw. And it started getting worse and worse and worse. We went through 2008, really till about 2011. And 2011, August of 2011, Mario Draghi came out and said they'll do whatever it takes. But here we are, going into 13 years of doing this commentary. Are we now about to repeat, say, a 2008 scenario? And is it worse this time?
It feels like rapid fire is in motion now. And there is something of a repeat of 2008, 2009. If we said it was an extension, it wouldn't be an exaggeration. Extension of the global financial crisis, 2008 and 2009. Because the only thing that changed from then to now was a series of promises and the market's perception of whether or not the central bank community could deliver on those promises. Now, what the relevance of those promises actually was or is, I think has to still be weighed and measured. What we have seen in a very concrete way is that global debt to GDP is now 322%. And that is just astounding. We've added close to $50 trillion in debt since the global financial crisis. There's no lack of things for us to talk about. on the Weekly Commentary. And I think things are about to get wild and woolly.
Well, one of the things that's changed, when we started this Weekly Commentary, it was just us. And at this point, we've been added to a network that we want our listeners to be aware of because there will be like-minded programming on this network.
We've been working with a group for 13 years that has done the sound engineering, and they do a lot of content production themselves.
Right.
And so mentioning who they are and what they do, I think as an added resource, if you're sort of in the market for, again, doing your own thinking and gathering your own information, we'd like for you, the listener, to know about what is essentially a new offering. Our commentary is listed there. SPN Podcast Network is a free mobile app. Just look for SPN mobile app, and you can find a whole host of podcasts, whether it's on iTunes or Apple Podcasts or Spotify or Google Play. But the Weekly Commentary we do is on SPN, and there's a number of other podcasts that you might be interested in as well, with our partner studio, which they produce. So if you're interested, search SPN Podcast Network. And here we are 13 years on, still doing the podcast every week. Love doing it. I don't think we called it a podcast then, because I don't think actually they called it. I don't think that existed.
It was supposed to be a radio program. Do you remember we were sitting there talking about doing a radio program? I think it was going to be based out of Texas. And, the suggestion came, well, why wouldn't you do a podcast? You realize that's the 21st century answer. And boy, am I glad we did.
Radio syndication was the conversation 13 years ago.
It was. I remember the meeting.
And literally, podcast, that was not a word. It didn't exist 13 years ago. But we were doing a show and publishing it to the internet.
Right.
And what a bizarre and happy world we live in. I think one of the things that I'm very grateful for with the commentary is that over 13 years, this discipline on a weekly basis has kept me engaged at a level and forced a discipline in study and in conversation with people who are better than us, which has made us better. And that, to me, is just an expression of being a lifelong learner. When I think of our listeners, I think of a group of people who are lifelong learners. The reason they're here is because they're curious. The reason I'm here is because I'm curious.
Dave, I go back and listen to podcasts so that I can relearn what I've already forgotten. So, yeah, I was here sitting here with you when you said it.
I'm back to that original theme that you brought up of being an independent thinker. No time like the present to be digging deep and to organize resources around how you process what's happening in the world and what you can be doing about it.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, and now on the SPN Podcast Network as well. Give us a call at 800-525-9556 anytime.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.